It has now been over 10 years since I bought my first real estate investment trust, or REIT in short. I still remember that my first REIT was actually a mortgage REIT called CYS Investments. In case you're not familiar with mortgage REITs, these REITs differ from your traditional REITs in that they don't buy properties. Instead, they would typically make debt investments such as loan to other real estate investors and also buy debt securities. What attracted me to mortgage REITs back then were the high dividend yields that they offered. CYS Investments offered a dividend yield in excess of 10%, its lending strategy appeared to be resilient, and it enjoyed attractive growth prospects. But despite that, like most mortgage REITs, it turned into a value trap, and my overall returns ended up being rather disappointing, as I could have earned higher total returns by buying lower yielding equity REITs like Realty Income. I think that this is a pretty good representation of my overall experience investing in mortgage REITs. At times, their high dividend yields have caught my attention, but in the end, more often than not, I've regretted being so greedy for income. These days, I rarely ever buy mortgage REITs anymore, and in today's video, I'm gonna explain to you why. Hey everyone, this is Jos. I run a small investment firm that specializes in REIT investing, and in today's video, I'm gonna give you 5 reasons why I stay away from mortgage REITs in most cases. But before I get into it, could you please do me a huge favor and like this video? That will really help me a lot to grow this channel. Thank you so much for all your support. So the first reason why I tend to stay away from mortgage REITs is that they have a horrible track record. On average, the mortgage REIT sector has generated 2% average annual total returns over the past 20 years. That's roughly 4 times less than the average of equity REITs which own properties. Investors earned high dividend yields, but this came at the cost of eroding share prices, which led to very poor total returns. Here you may ask yourself, why is that? And this brings us to the second reason, which is that I think that most mortgage REITs have a broken business model. The main issue with most mortgage REITs is that they are too dependent on highly unpredictable macro factors such as the level of interest rates and their directions and the spreads. They make leverage bets that earn good returns during some time, but then as macro factors change and they fail to predict those changes, they suffer significant losses. A very good example of that would be the dividend track record of Annaly Capital Management, which is one of the biggest and oldest mortgage REITs. I'll put a chart here on the screen somewhere and you'll see clearly that its dividend track record has been very inconsistent, as it's been unpredictable to consistently time the changes in the macro environment. In my opinion, this makes the whole business of mortgage REITs very unattractive. What I really like about the business of a landlord is that it's very consistent and predictable. As long as you own a property that's well located, you don't over leverage and you manage it well, you're likely to enjoy growing rental income over time and your property is likely to gain value over the long run. However, the same consistency doesn't exist in the mortgage REIT sector because once more they are too heavily reliant on these unpredictable macro factors. And what makes things even worse, of course, is that mortgage REITs tend to use a lot of leverage, and this brings us to the third reason, which is that they are typically over leveraged. Today, most equity REITs which own properties such as Realty Income use very little debt. In fact, their balance sheets are the strongest they've ever been, with an average LTV of around 30% and long debt maturities of 7 to 8 years, which also well staggered. But mortgage REITs are different. They're quite a bit more aggressive, they're using far more leverage when they make their investments, and this comes at a cost. This leads to great returns during some years, but then once the cycle turns, they suffer great pain, and as a result, they tend to go through boom and bust cycles, which is not something I'm looking for as an investor. Then the fourth reason why I stay away from most mortgage REITs is that they tend to suffer significant conflicts of interest. Here you need to understand that REITs can have 2 different types of management structures. They can be internally managed or they can be externally managed. When a REIT is internally managed, what it essentially means is that the management is hired as employees of the REIT and they earn salaries for working exclusively for this specific REIT. The salaries are typically aligned to some key performance indicators that are reflective of shareholder value creation. Today, most equity REITs are internally managed because it leads to significant economies of scale, as well as a better alignment of interest between the manager and the shareholder. A great example of that will be Realty Income, which has a management cost as a percentage of its total assets of just around 30 basis points. Externally managed REITs, on the other hand, will outsource the management to a separate asset management company, which will provide asset management services in exchange of fees. These fees will typically be a percentage of the assets under management, as well as an incentive fee if they can meet a certain return threshold. The issue with these fee structures is that they will typically reduce any potential for economies of scale because the percentage fee won't change even as the REIT grows larger. And then second issue is that it will also lead to significant conflicts of interest, because if you're earning a percentage of the total assets under management, then you're going to be incentivized to grow, even if it comes at the cost of shareholder dilution. Today, most traditional REITs that own properties are internally managed, but there are a lot of mortgage REITs that have remained still externally managed despite all these issues. Two good examples here of externally managed mortgage REITs will be Blackstone Mortgage Trust and Starwood Property Trust. I actually think that both of these mortgage REITs are quite attractive today. They are heavily discounted and their business models are more resilient than what the market gives them credit for. But one of the main reasons why I'm not buying them is because they're externally managed, and I fear that this will lead to significant conflicts of interest that will cost some of my returns over time. And so to end this, the fifth reason why I'm not buying mortgage REITs is that I think that they offer relatively poor risk to reward in most cases. They of course offer very enticing dividend yields, and that's really what's attracting most investors to this sector, but on the flip side, they're highly dependent on unpredictable macro factors, they're heavily leveraged, and they suffer significant conflicts of interest and expensive management. This explains why most of these REITs have such a horrible track record, and since their businesses have not materially changed, I wouldn't expect future results to be materially different either. Therefore, I would much rather buy lower yielding equity REITs like Vici Properties, Essential Properties Realty Trust, or even Realty Income, earn a dividend yield in the 5 to 7% range, and then add to that 5 to 7% of annual growth, which would easily get me to double-digit total returns. If that REIT is undervalued, you perhaps can add some more repricing upside on top of that. That's a much more attractive value proposition to me than what most mortgage REITs are today offering, despite their higher dividend yields. Now, if you want to access my entire real money REIT portfolio as well as all my transactions in real time, feel free to join High Yield Landlord, which is my REIT newsletter, for a 2-week free trial. I'll put a link to it somewhere in the description of this video. This is a real 2-week free trial, as you won't be charged anything in the first 14 days. You can cancel, no questions asked. So if you just want to come in to see all our topics, that's perfectly fine with us. And then finally, once more, if you could please click the like button, that really helped me. Thank you so much for your support, and see you at my next one. Bye bye.